As every economist under the sun this year tries to define the recession that we're in, I think I finally heard somebody hit it right on the mark. It's called a rolling recession, and it's coming soon to an industry near you. The Federal Reserve, they met this week, they went 50 basis points. They also, in my opinion, redefined the term lame duck with that rate hike. All economic data is slowing, and some more severely than others, yet the Federal Reserve vows to keep rates higher for longer and to keep going. They should ask around. People break their vows all the time. And mortgage rates, some good news. We are out of the danger zone of affordability and consumer appetite. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. Hope you had a great week. Okay, so finally, saw something on TV. Somebody defined this recession. It's called a rolling recession, and I love that. It's a perfect description. Usually a recession happens to every industry at the same time. This time around, a little different. Recessions have first hit industries that are more rate sensitive, such as housing, for example. But I love this term, and it's slowly but surely going to hit every industry unless the Federal Reserve notices what's going on and actually chills out. But I'm loving this term, rolling recession. Moving on to the Federal Reserve. That had to have been the most lame duck 50 basis point rate hike in the history of rate hikes this last Wednesday. It's going to accomplish absolutely nothing. It will never be noticed in the economy because by the time it works its way into the economy, 6 to 8 months down the road, for example, they're probably going to have to be cutting rates because we have gotten some other economic data that shows that things are slowing and in some industries pretty quick. So I bet you this latest lame duck rate hike and then the other ones they plan on doing, we'll never see the effects because they're probably going to have to start cutting rates before those can kick in. And they are still experts in the trial balloon. Earlier this week, weak economic data came out. Markets rallied across the board. Federal Reserve did their lame duck hike on Wednesday. And then markets didn't react how they wanted, so they put some trial balloons out there and absolutely tanked the markets for the last 2 days. Other than the bond market, which doesn't believe them, but we'll get to there. And back to this vowing to keep rates higher for longer. Listen, ask around. More than 50% of Americans break their sacred vows every single year. I don't think the Federal Reserve is above that. My guess is their little vow to keep raising rates and to keep higher for longer, not going to happen. And especially, they're going to get this way wrong if they are unrealistic in their target rate for inflation. The way they're currently measuring data, they might have to get a different type of ruler out to measure what's going on right now. And as I mentioned, all economic data is slowing, retail specifically, but yet the Federal Reserve vows to keep going. I bet you they're going to stop sooner rather than later. And moving on to mortgage rates, we are out of the danger zone. About 6 weeks ago, I want to say, we were at a point where I would quote a rate, I didn't even want to say it out loud, because one, the consumer didn't want to hear it, and two, the consumer didn't or couldn't afford it, didn't want to afford it or couldn't afford it for that matter. But in the last month, call it, we've come down from a 420 to a 350 yield on the 10-year Treasury, and the bond market sincerely does not believe the Federal Reserve. And that's why they came out with their trial balloon the day after their meeting, the morning after for that matter, to tank the stock market. But the bond market doesn't believe anything the Federal Reserve is doing at this point. The proof is in the pudding. Look at the inverted yield curve that we continue to have on Wall Street. The shorter term maturities are much higher than the longer term maturities, which is a classic sign of recession. So bond market doesn't believe a word the Federal Reserve is saying. And this is all great for mortgage rates because if the Federal Reserve does indeed tank the economy, because it's slowing down naturally because the money we always talk about is working its way out of the system. But if they do tank the economy, which is what the Treasury yields think right now, and what bond yields, mortgage-backed security yields are thinking right now, mortgage rates are going to come down if we hit a recession that the Federal Reserve will indeed acknowledge. So actually, bad news is good news when it comes to mortgage rates, and I don't think this time's going to be any different. Okay, everybody, that is my show for this week. Next week is the holiday week. Please, happy holidays to everybody. Enjoy yourself. Please be safe. Please take care of each other. Be conscious of the people around you. And as always, please, if you have any mortgage-related questions, please don't hesitate to reach out to me. Have a great and wonderful holiday. Thank you so much for watching, as always.